After the subprime crisis, which began in the United States in 2007, the G20 decided to implement a series of countermeasures to reduce systemic risk in the financial markets. In particular, one linked to the exchange of derivative products outside the regulated markets, the so-called over-the-counter derivatives. This new wave of regulations will also have consequences on energy trading and on financial instruments applied to commodities and especially to energy, although the latter only represents a minimum portion of derivative volumes. Indeed, according to the Bank for International Settlements, in 2011, only approximately 5% of the OTC worldwide value of derivatives had a non-financial underlying product. We shall see how, in the European Union, the energy trading is being influenced by a set of new regulations. The regulation on wholesale energy market integrity and transparency bans insider trading and market manipulation and provides for the obligation to publish data on exchanged energy products. Some points of these regulations. Already in force since the end of 2011, despite not being fully operative. Setting up monitoring in the energy markets by the Agency for the Cooperation of Energy Regulators. Banning the misuse of privileged information and market manipulation. Making compulsory the disclosure of privileged information. The European Market Infrastructure Regulation on the OTC derivatives, central counterparties, and the indexes on transactional data became law on the 16th of August 2013 and has been in force since the middle of March 2013, setting the obligation to trade derivatives on central counterparties or to mitigate the counterparty risk of the OTC transactions, the obligation to report the OTC transaction. The New Markets in Financial Instruments Directive. The Directive, in force since 2007, lays down a set of rules for companies operating in the financial markets, rules which make this business more burdensome against better guarantees for the clients. However, these rules do not apply to those who work with derivative tools on commodities, provided that it is ancillary to the main business. Neither for those whose core business consists in transactions on commodities or on derivatives on commodities on their own behalf. The proposal to review the Markets in Financial Instruments Directive may lessen these exemptions, moving the energy trading business towards a regulatory system similar to the one set for the financial trading business. What consequences for energy markets should we expect from these new regulations?